Payments are evolving at lightning speed. From open APIs to programmable digital currencies, the way we move money is changing, not just for banks, but for businesses, developers, and everyday users. As payment professionals, we do not only need to understand the new usage, but also the technologies behind this new evolution and how to implement new services. Hi, my name is John Paul, payment blogger, author, and co-founder of Paymerix. What would you say if I told you that to grasp key trends and what is happening in the industry, you need to understand a few basic things? And what would you say if I could reveal you the secrets to understand these basic things in a very simple way? In this video and the next, we will dive into some of the biggest forces driving the current changes in the payment industry and how they are building the foundation for a new global financial infrastructure. What you will learn will provide you a strong foundation to understand the current and upcoming changes and tackle related subjects for at least the next 10 years to come. So, what you will learn can have a significant impact on your career in the payment industry. Stay tuned and watch this video and the next very carefully. This video is about two forces with significant impacts on the payment industry. The first is open banking and the second is cryptocurrency and tokenized payments. Let's begin with open banking. Think about how you use your bank today. You might check your balance on your phone, send money through an application, maybe even get a loan offer in your shopping app. Here's the twist. Most of these experiences don't happen inside your bank. They happen outside through applications and services that are powered by your bank's data. And this is open banking. It's changing the rules of how we access, move, and control money. To easily understand open banking, let's consider how banks were operating before open banking. Here, you can see a bank with its applications and customer data. Before open banking, customers could only use applications developed and made available by the bank itself to access their data. In other words, to view their account balances and initiate transactions, it was not possible to use another application provided by an external party. Open banking enables third parties to create applications that bank customers can use to access their data. That's it. To make it possible, banks must provide the so-called APIs or application programming interfaces. Banks therefore become API providers to third parties. And third parties can make use of these APIs to create innovative services. As we will see later, there are different APIs that can be used for many purposes. But we already saw an important point here. To understand open banking, we must understand APIs, what they are and what they enable. At its core, open banking is about giving control to customers over their financial data and allowing them to share it securely with third parties they trust. You have probably already heard that data is the new oil or the new gold. Like gold, data has immense value. In general, when organizations have something that is of immense value and give a competitive advantage, they protect it. They do not want to share it. Logically, it is not in the interest of banks to share their data, and they will not have done it naturally. That is why banks were required by law to open up their APIs so other companies, other institutions can build products and services on top of traditional financial infrastructures. In Europe and UK, it started with regulations like PSD2 and UK open banking, followed by similar frameworks in Australia, Brazil, and beyond. These policies force banks to provide standard interfaces so developers can safely plug in and innovate. Open banking has serious consequences in the banking and payment space that we as payment professionals need to be aware of. It's not solely about data sharing. It is a disruption with significant implications. Let's consider a traditional four-corner model, and then let's see how open banking regulation has impacted it. In the past, payment service providers were all banking institutions. With open banking, new players become bank competitors and offer payment and financial services without becoming banks themselves. And not all third parties are the same. Open banking defines two critical roles: AISP, which stands for Account Information Service Provider, and PISP for Payment Initiation Service Provider. Many fintechs play one role or the two roles. In this diagram, with the PSP in the four-corner model, we see that open banking presents a significant challenge to traditional banks in maintaining and strengthening their customer relationships, because one major challenge is disintermediation. Since third-party fintech companies can access bank customer data and offer services directly to the customers, this can disintermediate banks, meaning customers may start interacting more with the fintech application than with their bank's own services. Therefore, banks need to find new ways to make their customers use their own apps and remain loyal. On the other hand, banks can also act as account information service providers and payment initiation service providers themselves. This allows them to offer their customers a consolidated view of their finances across different institutions and initiate payment from those accounts. As a consequence, the competition is intensifying in the payment space. But this strategic move presents both opportunities and threats to banks. Now think about these interesting questions. What typical API exists in open banking? Where do you find them? How to read the documentation on APIs? Which pitfalls should we avoid during API implementations? Well, in the next video, I will tell you how to get answers to these questions and much more. So stay tuned and make sure you watch the next video. So far, we have talked about how open banking is opening up access to financial infrastructure. But what if the money itself was programmable? What if value could move as easily as data, peer-to-peer, 24/7 with no middleman? These questions set the stage to our next topic: cryptocurrency and tokenized payments. This is truly a revolution that we as payment professionals must understand. From bartering to banknotes, money has constantly evolved. But the biggest transformation we think is happening right now. We are on the brink of a new era where cryptocurrencies and tokenized payments are changing how we buy, sell, and interact with value itself. Before moving on, let's define these key terms: cryptocurrency and tokenized payments. What is a cryptocurrency? Cryptocurrency is a combination of the words crypto and currency. Crypto refers to cryptography, which is used to secure transactions and control the creation of new units, while currency refers to the medium of exchange used in financial transactions. Obviously, cryptography plays a key role in cryptocurrency, and to really understand cryptocurrencies, we need to grasp basic concepts on cryptography that include public and private keys, hash functions, digital signatures, and blockchain technology. Understanding these cryptographic principles is essential for grasping how cryptocurrencies function, their security features, and the trust model they operate within. As the cryptocurrency landscape evolves, being informed about these underlying technologies will help users navigate this dynamic and rapidly changing financial ecosystem. Cryptocurrencies operate on decentralized networks based on blockchain technology, which is a distributed ledger that records all transactions across a network of computers. This decentralization means that cryptocurrencies are typically not controlled by any central authority, such as a government or a financial institution, thus providing users with greater autonomy over their funds. Compared to traditional systems, crypto offers some interesting advantages: faster transactions, lower fees, especially for international transfers, and greater accessibility for people around the world who don't have access to traditional banking. These benefits arise from the operational model of cryptocurrency systems. In contrast to cryptocurrencies, traditional financial systems follow an open-loop structure where transactions are conducted and finalized within a designated institution, typically a central bank. Commercial banks act as intermediaries connecting their customers to the central bank systems. This reliance on intermediaries can introduce delays and additional fees into the transaction process. Conversely, cryptocurrencies function on a closed-loop model, primarily utilizing blockchain technology. A fundamental principle of cryptocurrencies is to eliminate the intermediaries. In the crypto world, there is no need to go through a financial institution to transfer funds. But this brings also many responsibilities end users must be aware of. Now let's talk about tokenization. First, let's answer this question: what is a token? A token is an asset that represents a unit of value or utility in a specific context. It can be used to signify ownership, access, or rights within a particular system or platform. A digital token is a specific type of token that exists in a digital format and operates within digital frameworks. These tokens can represent various forms of assets such as cryptocurrencies, digital collectibles, or loyalty points. Unlike coins, which operate on their own blockchains, digital tokens are built on top of existing ones like Ethereum or Binance Smart Chain. Now, imagine taking any asset, a dollar, a share of stock, even a piece of art, and turning it into a digital token on a blockchain. That is tokenization. So the value of a token comes from what it represents rather than the token itself. If I tell you I have tokens, your immediate response will likely be, okay, tokens of what? Without understanding what those tokens represent, knowing that I have tokens wouldn't hold much significance to you. Essentially, the worth of a token is intrinsically linked to its underlying assets, utility, or purpose within a specific ecosystem. This is why context matters so much in the world of tokens. Tokenization has a wide range of application across various industries. Tokenization of cards, for example, refers to the process of replacing sensitive card information such as credit or debit card numbers with a unique identifier or token that is usually valid during a few minutes. This token is generated through a secure cryptographic process and is useless if intercepted because it does not contain any real account information. Tokenized payments make transactions more secure. Instead of sharing your sensitive card details, a unique token is used for each transaction. This token is useless to hackers, making it much harder to steal your information. Tokenized currencies refer to digital representations of traditional currencies or assets that are created on a blockchain. These tokens can be pegged to the value of fiat currencies like the US dollars, euro, or other assets, combining the benefits of blockchain technology with the stability of traditional currency. So, instead of sending fiat currencies through the traditional banking system, more and more people now prefer to send tokenized currencies over the blockchain because it is cheaper and faster. Examples of tokenized currencies are stablecoins and central bank digital currencies. Stablecoins are designed to minimize price volatility by being pegged to a stable asset. Examples include Tether or USDT and the USD coin or USDC. Each of them is pegged to the US dollar and aims for one-to-one stability. Central bank digital currencies, or simply CBDC, are digital representations of a country's fiat currency issued and regulated by the central bank. While still in development in many places, central bank digital currencies aim to provide the benefits of digital payments with the backing of the national currency. Cryptocurrencies and tokenized payments have the potential to revolutionize entire industries, create new financial systems, and empower individuals in ways we never thought possible. The market is expanding rapidly. Experts predict that tokenization alone could unlock trillions of dollars in new value in the coming years. Of course, this revolution isn't without its challenges. Clear regulation, robust security measures, and user-friendly interfaces to ensure widespread adoption. But the opportunities are enormous. Companies like PayPal and Visa are already integrating crypto. Governments around the world are exploring central bank digital currencies. The world of finance is changing rapidly, and cryptocurrencies and tokenized payments are at the forefront. It is an exciting time to learn more, get involved, and be a part of this transformation. What do you think? How will crypto and tokenization change your life and the world? This is really an exciting time to be in the payment industry. In this video, we spoke about open banking and cryptocurrencies and tokenized payments. Open banking enables end users to use applications provided by third parties to interact with their bank. Banks are required by law to provide APIs that third parties can use to access customer data. Cryptocurrencies and tokenized payments are based on the blockchain technology, where cryptography plays a paramount role. Read as much as you can about cryptography and the related concept. Tokenized payments benefit from blockchain's decentralized nature, which eliminates the need for intermediaries like banks or payment processors. This can lead to lower transaction fees and faster processing time, as transactions can be verified and executed directly on the blockchain. Additionally, tokenized payment systems can enhance accessibility, creating opportunities for unbanked populations by providing them with a means to participate in the digital economy without the traditional banking infrastructure. This can empower individuals and communities, allowing for greater financial inclusion and innovation in payment solutions. In the upcoming video, we will explore other significant trends that are crucial for understanding the future direction of the payment industry. These include the migration of SWIFT to the ISO 20022 messaging standards and the development of the one-leg-out instant payment schemes. Thanks for watching.